Donald Trump's new trade weapon is set to launch soon, outlined in Section 899 of One Big Beautiful Bill Act, a key legislative effort from his second term. The bill has passed the House and is now under Senate review. Section 899 of the bill introduces a retaliatory tax on foreign investors from countries the U.S. deems to levy unfair foreign taxes on American businesses, such as digital service taxes, DST, undertaxed profit rules, UTPR, and diverted profit taxes, DPT. These countries will be classified as discriminatory, and U.S.-sourced income earned by their investors will face a surtax. This chart shows you the top 8 countries by total U.S. asset holdings. Of these 8 countries, 2 will certainly be labeled as discriminatory countries. They are United Kingdom and Canada, because both of them imposed digital service tax on American tech companies. Digital service tax is a tax on the revenue earned by U.S. social media and tech firms within a foreign country. For example, if Google earns $1 in Canada through ads revenue, Canada government will take 3% of that. And similarly, in UK, the government will take 2% of that. Outside of the top 8 countries, I'm sure there's a lot more countries have digital service tax, but right now I know 2 of them. There's France and Australia. So Section 899 of the bill targets so-called discriminatory countries by adding 5% to existing US tax rate in the first year and increasing by 5% annually, capped at 20%. So give you an example, currently the US imposes a 15% withholding tax on dividend payment for UK and Canada, and 0% for interest income. So if the One Big Beautiful Bill Act passes, this rate would increase by 5% annually, reaching 35% maximum in 4 years. At that point, dividend income will be taxed at 35 cents per dollar. For interest income, Section 899 is designed to override existing tax treaties, meaning that even though currently they are tax exempt, they don't have to pay tax, 0% withholding tax for interest. Like when a Canadian investor buys US Treasury bill, they don't pay any tax, withholding tax, right? Even though it's exempted, there's a possibility that the income will also face a 5% annual increase, and in 4 years, up to a maximum of 20%. So what's the implications for foreign investors? So for investors that invest in US asset with a growth-oriented portfolio, right, these type of investors are not relying on dividend or income. So the impact this rule will have on those investors are limited, because these type of investors focuses on capital gain and stock price appreciation. However, income-focused investors who depend on dividends and interest income will be significantly affected. That being said, local publicly traded companies may be benefited from this, as some capital will be shifted from US to local companies. But still, for retail investors from those foreign countries like Canada and UK, it's very hard for them to move away from US stock market due to the TINA effect. There is no alternative. Historically, over the long term, US market has consistently outperformed other markets. Thank you. Please like and subscribe.